Beat estimates, but the firm loses its title as the UK's largest asset manager to Schroders. Matt, good morning. Futures looking relatively unchanged. We'll have to see how these markets open this Friday morning.
Yeah, absolutely. Although we did see futures down a lot more earlier, and we saw Asian markets fall overnight as well. So it seemed the mood very risk off, and maybe it turns around now on hopes for a better jobs number than maybe the market is anticipating, and some stimulus out of Washington. As we see equity indexes start to open up, let's pull up the global macro movers screen. You'll see the left-hand column populate as these equity indexes open up live. When there's little change, the block stays gray. It needs to move more to turn red or green. And we're going to see, I think, a lot of gray across the left-hand column today. Although there the IBEX goes down 0.5%. The FTSE opens up very little change. The CAC 40 opens up down 0.25% this morning. So markets, if they're not moving much, they definitely seem to have at least a direction, and that is to the downside. Stocks in Asia, as I said, dropped as U.S.-China tensions escalated. President Trump has signed executive orders banning U.S. residents from doing business with the Chinese-owned apps TikTok, I should say. I always say Tic-Tac, like it's a little snack that's only 1 calorie. TikTok and WeChat, the app owned by Tencent. The move knocked Tencent down, and in Europe and Africa, Naspers and Prosus are also sliding. They hold shares. They're the proxy for Tencent. The action that Trump signed comes into effect in 45 days, but it marks a significant escalation in tensions with Beijing. It's not just about this. Joining us now to discuss is Ben Guttridge, Invesco EMEA Director of Model Portfolio Services. Ben, I guess the question investors are asking a little bit longer term is, are we in a U.S.-China Cold War? Is this just one more move that takes us deeper into this to this conflict?
Well, of course, it could well be, and the protagonist clearly is Trump in this instance, and perhaps throughout the series of escalations. And of course, if he's returned to the White House with no third election to fight and the reins off, if you like, then yes, whilst markets may cheer the avoidance of perhaps a re-regulation in certain areas, that US-China Silicon War will be in the forefront of investors' minds and could well weigh on the relevant parts of the market. So, yeah, but I mean, of course, the counter-argument to that is that Trump isn't the favourite to be returned to the White House. And of course, it's not necessarily the route that he will choose to take to get himself back into the White House either.
What about this trade meeting on August 15th? Could that ease some of these tensions, Ben?
Well, yes, it could. I mean, it doesn't seem apparent that you can get an immediate turnaround when you're doing sort of negotiations, or indeed covert negotiations with such sort of bold steps, it's hard to take a dramatic U-turn so soon after. And I don't think China is going to offer necessarily the concessions that Trump would need to sort of step down from his sort of current position. So it would be a surprise if there were, sufficient ground broken to put an end to, or indeed dampen US-China trade concerns at this moment.
So, in the case of a worsening relationship between the world's two most important economies and coronavirus news that just looks bad every time you check. Right now, Hong Kong's Carrie Lam is saying that the situation there remains severe at a briefing that they're holding, but it looks severe in a lot of really important places, Ben. Why have markets continued to rally? Yesterday we got a new high again in the S&P 500 at 3349. Global stocks have turned positive for the year. Why this bullishness in risk assets amid such bad news?
Well, you're right. It is likely that sort of string of news, that collection of news, could easily sort of weigh on sentiment and bring about volatility. But I think if we're thinking fundamentally about how we value shares, we look to not just this year or next year's earnings, we're looking well into the future for the potential cash flows. And of course, there's some sectors that have been sort of structurally impaired, potentially structurally impaired. And there are others, big parts of the market, of course, where their market share and their dominance in business and consumer lives have been elevated. So it's not for certain that the earnings outlook well into the future for the broad market has been sort of undermined by these issues. But of course, the other factor is how are we going to value those future earnings today? And you typically do that using a discount rate, real rates, interest rates, the various measures. And of course, they've fallen dramatically, which really elevates the value of those future cash flows today. So I think markets are behaving quite rationally, but that doesn't remove the risk of sort of short-term volatility as these very serious issues that you raise leak into investor sentiment.
Also, investors care about dividends. We've seen a lot of dividends cuts. Companies are just desperate to hold on to cash. How much is that weighing on sentiment in your view for earnings?
Well, in my own domestic market, of course, it's weighed heavily on sentiment. The FTSE 100, traditionally a big dividend payer, pretty concentrated in where you get the biggest chunks of dividends from. And we've seen, pretty serious dividend cuts, I think sort of 40% there or thereabouts in terms of the delivery of dividends. But, that's a pretty big number, 40%. I don't think it's too heroic to suggest that perhaps we've reached the base now in dividend cuts, and people can look at dividend forecasts with a little bit more confidence that they're going to receive those lower numbers that they are. So maybe that floor in dividend cuts represents a chance for UK equities to perform a little bit better relatively than they have done to date.
All right, Ben, we're going to keep you with us. More from Ben Guttridge, Invesco EMA Director of Model Portfolio Services, stays with us on what is a pretty important day for the U.S. economy. President Donald Trump could take executive action if a new stimulus deal isn't reached. So that's one thing we're going to be watching. And then the granddaddy of all economic statistics comes out, the non-farm payrolls number in Washington later on. We'll discuss. This is Bloomberg.
Good morning, everybody. Hope you all right in this sunny day in London. I placed in a new order to sell short Japanese yen. The price I'm looking to sell at 105.567. So order placed, and let's see what's going to happen. Just to remind you, we show you 5 pairs on the screen. Japanese yen, here it is, British pound, Canadian dollar, euro, and Bitcoin. All these pairs we trade live with our own money. Every pip, each pip equals £100 profit or loss, except Bitcoin, where 1 pip equals £10 profit or loss. If you would like to use our strategy, you need to get it from our website, or you can see on our ticker on the streamer. So get it, follow us for free, and make some profit as well as we do. Looks like it moved too fast, too far. The price for Japanese yen probably will not be, it will not be possible. Let's see what's going to happen with this candle. If it will not get executed, I will have to cancel the order. Let's see. You know what? I'll hold it for a while. So, order still on. So let's wait. If anybody needs to help in opening an account or a margin account, as we trade all our pairs on margin, so just let us know. Send us an email. If you want to find, you will find our email in description, or the way all people do in order to contact the companies, and we can help you to create a trading account. All right. Speak to you later, guys.
119 million customers. Standard Life Aberdeen has lost its title as the UK's largest standalone asset manager. The firm saw assets under management fall to around £510 billion in the first half of the year. That takes it below Schroders. The outflows at Standard Life Aberdeen were driven by Lloyds Bank moving a large investment mandate from the company to Schroders. That's your Bloomberg Business Flash. Matt, Anne-Marie.
Laura, thanks very much. Laura right there with your business flash out of London. Now, President Donald Trump says he will take executive action if a deal on new stimulus isn't reached today. As the July jobs report looms, economists have warned further delays could exacerbate the spike in Americans leaving the labor force and slow the recovery. Ben Guttridge is with us, Invesco EMEA Director of Model Portfolio Services. Ben, let me first ask you about this stimulus, your expectations for stimulus. Do you think the Dems and Republicans come to an agreement, or do you think President Trump comes out with a satisfying executive order?
Well, I guess my base case would be that we get an agreement between the Democrats and the Republicans. I think, you know, it's sort of classic negotiation strategy, isn't it, to take it to the 12th, 11th, past the 12th hour, to make sure you're seen to be fighting as hard as you can for those who you represent. So I would expect a deal to be done. Of course, if it's not, you could get the Trump executive order. Of course, I think there could be an extension that allows Congress to sort of negotiate for a little bit longer. Of course, these things could inject volatility into markets, but how it comes is certainly up for debate, but I'm pretty certain it will come.
Ben, I think a lot of people would agree with you, but actually even say we're not even at the 11th or 12th hour. Some of these stimulus measures expired last week. That potentially could have been, and probably should have been, for some of these consumers, the deadline. We don't know what's going to happen out of D.C. just yet. You're hopeful, which I think is good. But I want to move on to the jobs number. That's the data we're all going to be looking at today. And if you go to the eco page on Bloomberg and you look at the non-farm payrolls, the estimates are so wide-ranging. We have a low estimate of negative 600,000 jobs, while the highest is to add 3.2 million. What's your take? Where do you see the U.S. labor market going?
Well, I mean, I think you raise a great point. The scale of variation in the expectations is a reflection of the tremendous amount of noise there is in all the underlying data, other surveys, whether it's the sort of home-based survey, the ADP, the employment surveys underneath the ISM. There's a lot of conflicting data out there, but I think the general trend, whether it reveals itself in this number or next, is that job creation is slowing in the face of a rising number of COVID cases, particularly sort of in those southern states. Of course, there's better news in that it could be that those infection rates are peaking out, and that will be better news, obviously, for job creation going forward. But I think the clear trend that we're seeing is that job creation is slowing, and that perhaps the Fed can't get any more dovish, but it will recommit, will cement its dovish orientation, and really should be pushing the Congress to get over the line with this stimulus deal.
But Ben, what's your number? On this range, where do you stand? How many jobs do you think are going to be added to the U.S. labor market today?
Well, I'm sorry, I wouldn't want to commit to a number. I think, it could be 4 million. I mean, that highest number of 3.2, it could still get past that. It could easily be a 4 million number, and it could be a negative number. And what I suspect is, the markets will typically sort of trade on the news. If you get a better than expected, markets will rally, but they would fade after that. And likewise, if you get a weaker number, a bit of modest disappointment, but I expect fundamental investors sort of to return thereafter. So we don't get too anxious about this big number. We're not trying to downplay it in the contribution to trends, but the single day and the single reaction isn't something that we play, I'm afraid.
Yeah, and the whisper number, we should tell, if you're on a Bloomberg Terminal client, it's 1.1 million, and you can go add yours there. I guess we'll have to wait for some clarity. Ben Guttridge, Invesco EMEA Director of Model Portfolio Services, thank you so much for joining us. And of course, he'll be continuing the conversation with Matt Miller on Bloomberg Radio. That's at 9 a.m. UK time. Now, coming up, Chinese tech in the firing line as President Trump bans U.S. residents and companies from doing business with TikTok and WeChat. We bring you all the latest. This is Bloomberg.
Okay, great. New position open for Japanese yen. It's a short position at 105.567.
welcome back to the European Open. We're 18 minutes in today's trading session, relatively flat across the FTSE and the DAX, but the CAC are under a little bit of pressure, down nearly 0.3%. Now here in London, the Bank of England says it won't tighten policy anytime soon, despite the UK economy showing signs of a faster rebound than initially expected. Governor Andrew Bailey told Bloomberg's Francine Lacqua that negative rates will be part of the bank's toolbox, but no plans to take them out yet.
The things we've looked at are broadly further QE, further quantitative easing, potential use of negative rates, and forward guidance. Those are the things that we've looked at.
So yield curve control has not been discussed, or is it something
I mean, obviously yield curve control is quite interestingly discussed in central banks, and we do discuss it. It's something that, I mean, we've preferred to look at quantitative easing and forward guidance as tools in that respect. But I would make the point that we will go on looking at the toolbox. You know, nothing is fixed down forever, but it's not in our planning at the moment.
What would it actually take for you to go into negative rates?
The issues that we most focused on, and we've talked a lot to the central banks that have done them. Those have gone in, come out, gone in, not yet come out. Really very, very helpful and fascinating conversations, lots of the work they've done. And I'll draw 2 points out of it. One, as you get into this territory, there is, I think, a much bigger interaction with the structure of your financial system, and particularly the structure of your banking system. Nobody has really sent retail deposit rates negative, and I can understand why. Obviously, it means that the bigger the share of retail deposits in your banking system funding, the more attenuated the effect of negative rates will be. We've actually got quite a high share of retail funding in the banking system. So that's one thing. The second thing that I would conclude, looking at the experience of some of the other central banks, is that the effectiveness of negative rates does depend upon what point in the cycle you're using them at as well. And again, that's an interaction with the financial system as well.
But so would you see yourself using negative rates, post-COVID, so in a recovery phase, to actually help the economy then?
Well, I don't know is the answer, because we're not facing that situation today. I think it is true that when you look at the experience of other countries, they appear to have worked more effectively in the recovery phase. Now, I would, however, qualify that a bit by saying I think there's a tricky identification issue at that point as to what extent it's negative rates that are driving, for instance, the recovery of the banking system, the lifting of the release of provisions, and therefore the ability to lend, and to what extent that would have happened anyway, because it's a cyclical point. It's a rather tricky issue in that respect. So the evidence is there, but it's a little bit hard to identify the causes. But
then again, in terms of sequence, it's not something that you would rule out, right? It could happen at that phase.
Oh, definite message we're giving today is, look, they're in the box. I mean, there are other central banks that have said they're not in the box because, again, their financial systems have got different properties and they draw different conclusions, so I can understand that. They're in the box. We're not considering using them at the moment.
And that was the BOE Governor Andrew Bailey speaking to Bloomberg's Francine Lacqua. Now, President Trump has signed executive orders banning U.S. residents from doing business with the Chinese-owned apps TikTok and WeChat. The action comes into effect in 45 days, and it marks a significant escalation in tensions with Beijing. For more, Jody Schneider, Bloomberg's senior international editor in Hong Kong, joins us. So, Jody, first off, walk us through the executive orders. What exactly do they say? What do they do?
Well, basically, they threaten penalties on any U.S. resident or company that would conduct transactions with TikTok, WeChat, or their owners after these orders take effect, and this is in 45 days. The measure against WeChat blocks all transactions involved in the app, but it doesn't, interestingly, amount to a broader ban on dealings with its owner, Tencent, according to a U.S. official. The order against TikTok blocks all transactions in which its owner, the Chinese company ByteDance, or subsidiaries have an interest. So that seems a bit broader. This, of course, both of these come with President Trump's push for the sale of TikTok, which is, of course, owned by ByteDance, to an American company and comes just a day after Secretary of State Mike Pompeo urged U.S. businesses to remove both these apps from their stores. So these are obviously, it's not an entire surprise that they did this, but banning both of those by executive order is a big escalation in the technology battle with China.
And Jody, what does this mean for TikTok? How does this affect their talks right now with Microsoft?
Yeah, it seems that President Trump is sort of saying, hey, if you want to do this deal, you better do this soon, because these executive orders take effect 45 days from now. They've cited this national security concern of leaving a U.S. residents' personal data exposed. So the talks between Microsoft and ByteDance are apparently still going on. There's a lot of hurdles, and that's a pretty quick time frame to get something done that would satisfy the U.S. Side of things. But apparently the talks are still occurring, and it would seem that President Trump is trying to really fuel those talks by saying they have to be done within a certain amount of time.
Hey, just quickly on something else. You know, Anne Marie's all over the commodities beat, and this morning on our conference call, she pointed out that we could see new tariffs on aluminum from Canada, even though the U.S. and Canada, along with Mexico, just signed this free trade agreement. Is that starting to unravel as well, Jody?
Well, it looks like it could. I mean, that's really interesting because, as you say, there was a deal that was signed. So you think once that's signed, that it's in pretty good shape to remain tariff-free. But the U.S. is starting to make noises, and that this could happen. And President Trump, as we know, loves to at least threaten tariffs. He doesn't always follow through on them or removes them after a certain period of time or gives them some time to take effect. But that could certainly be in the offing.
Jody, thanks so much for joining us. Geopolitical tensions across to Beijing, as well as potentially what's going on with Ottawa. Jody Schneider, Bloomberg Senior International Editor based in Hong Kong. Thank you. Now, coming up, rise of the social. As the pandemic and anti-racism protests have swept the globe, we've seen the S rise in ESG, and we've seen these stocks outperform. More on this next, a really important story. Stay with us. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. Let's take a look at the broader European benchmark index, the Stoxx 600, and see how it's fared throughout the first half hour of trading. A little bit of a dip and then back to unchanged right now. If you take a look at the GRR screen on the Bloomberg terminal, you can see the group ranked returns, and telecoms are doing the best, as well as industrial goods and services. Deutsche Telekom right now up 2.3%. That's one of the reasons there. Vodafone up 1.3%, and it's pretty heavy as well. So those are two of the big gainers. As far as the losers, auto parts are doing poorly today, and we do see companies that make auto parts among the top 10 losers here, as well as Prosus, one of the biggest losers, and it holds a stake in Tencent, unrelated, of course, to the cyclicals, but definitely part of the top news today in terms of what's going on with the U.S. and China. Let's get the first word news, speaking of that right now, from Laura Wright in London. Laura?
Thanks, Matt. President Donald Trump is moving to ban TikTok and WeChat in the U.S. He's signed executive orders barring U.S. residents from doing business with the apps. It also applies to transactions involving TikTok owner ByteDance, but the order against WeChat is not as expansive and does not amount to a broader ban on dealing with its owner, Tencent. There are still hopes for a speedy economic recovery in Germany. A rebound in manufacturing is starting to catch up with the services sector. Industrial output gained nearly 9% in June. That follows on from figures yesterday that showed factory demand is rising. It suggests Europe's largest economy may bounce back more quickly than its neighbours. Hong Kong plans to offer free virus tests to all residents. That's according to local media. The move reflects a boost in testing capacity with help from mainland China. But Beijing's offer has been complicated by politics. There are concerns that the testing push will lead to DNA samples from Hong Kong being taken to the mainland, something the city's government has denied. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie, Matt.
Laura, thanks so much. Now, this week, the once reliable dividend stocks like BP and Glencore slashed their payout figures. And now with bond yields sinking further and real estate under pressure, the universe of income options is really shrinking. It's a hit to pension funds and other investors who rely on the regular source of income. And here with all the details is Danny Berger. Danny?
Emery, it's really no doubt that pensions have been battered up by the slashing of dividends across Europe because of the coronavirus. If we look into the details, you can see that the biggest dividend cuts, perhaps unsurprisingly, have come from the travel and leisure sector. But some of the other sectors that have dramatically cut for the year are ones that dividend investors, income investors, have really relied on. So you look at someone like energy, for example. You mentioned BP, Anne-Marie. BP was really one of these stocks that a lot of people invested in just because of its income property. And in the FTSE 100, it was the biggest source of payouts. Banks, another big sector to see dividends fall because of the ECB's regulation telling them to no longer seek payouts. And what this does is it really shrinks the universe of income options for investors. It's a big concentration risk. According to researcher AJ Bell, before entering this latest earnings season, just 20 firms were expected to generate 74% of the FTSE 100's total payout. And this has really thrown into question the attractiveness of these income funds. You can see the UK universe has been cut basically by a third. They're the level, they were about half the level they were 3 years ago. And a lot of this is driven by dividends being cut across the board.
Yeah, so the question I'm sure that's keeping pension fund managers up at night is what options do they have left for income? I mean, are they simply forced out on the risk spectrum?
That's certainly one option, Matt, if you're thinking I need to have that steady level of income, that dividend. But a lot of pension managers have really recommended you need to accept this temporary cut to income, that if you want to achieve your longer term goals, it means that you need to have your portfolio diversified. Hopefully after the virus, when we get a vaccine, things will return to normal. And you certainly can't really turn to bonds. Look at the sovereign bond yield. Still, the Stoxx 600 yield is much higher. It's at 2.7%. It's still more attractive than something like a German 10-year yield. And this really just means that investors, they need to dig deeper, and Matt, as you mentioned, into perhaps more risky assets if they do want to hold on to that income.
All right. Danny, thanks very much. Danny Berger there on the return story that I think many of us are giving so much thought. We want to turn to something else that is taking a big piece of the zeitgeist right now. That is ESG investing. The S in particular has risen in prominence in the last few months. According to Bloomberg and MSCI data, European companies with the highest ESG rankings, and in particular social rankings, outshine the broader market. Following on from the push to get more women on company boards, investors now want to see greater ethnic diversity as well, and companies have pledged to do better or racial equality after anti-racism protests spread across the globe. So what steps can they actually take? Adeline Diab is head of ESG investing for EMEA at Bloomberg Intelligence and joins us now. Adeline, talk to us about the performance of social investing, the S in ESG, so far this year.
Hi, Matt. Thanks for having me. Yes, ESG indices have outperformed for the second straight year, but particularly well during the crisis. For the first half of the year, the MSCI US, Europe, emerging markets, ESG leader indices have all beaten their benchmark. And the outperformance was partly driven by factor exposure, tend towards more of a mix of low volatility, high quality stocks. They had a positioning that was a natural fit, being overweight in pharma and tech and underweight in banks and energy stocks, but also the rise of the S. Companies that have taken into account or were able to adapt quickly to this new environment, that were agile, responsive, inclusive, were able to outperform the market. And so this is what's been happening on the S and performance.
Adeline, I mean, this pandemic has really just flipped the world upside down, fundamentally changing how we think, behave, how we consume. But what does this mean for investors?
Yeah, so we saw a convergence of crises, the pandemic and then the Black Lives Matter movement that have brought the focus on the S and ESG. And now investors must be prepared to ask questions. There's two things. First, it's critical to look at how companies responded to COVID. There has been a stark differences. And so at Bloomberg Intelligence, we designed the corporate pandemic response tracker, looking at employee welfare, community engagement, and operation agility. Companies that were able to reinvent themselves in order to meet a new context and satisfy new needs. Estée Lauder, Ralph Lauren have repurposed their facilities to produce protective equipment, and including masks or gowns, hospital gowns. A.O. Smith, a water tech company in the U.S. with General Electric, have repurposed their operations to produce ventilators, respirators. Delta Airlines, which is a company that you would never expect, has done remarkable, not because they found like a new way of flying, but because they really leveraged their skills in terms of scheduling to deliver logistical support to hospitals, to work with the military to leverage their production lines, to produce also face shields and masks. So these types of companies we help identify. And the second thing investors need to look at is how companies have managed diversity, how they have responded to the Black Lives Matters, and now as we seek to expand diversity measures. And so there is a significant important to look at data and how we can help that, because you can't
Adeline,
manage what you won't measure.
Yeah, you
Adeline,
cannot
how
manage
do
what
they?
you don't
I mean,
measure, so
well,
go for it, Matt.
I mean, well, it's interesting here, for example, in Germany, because you can't really collect racial or ethnic data so easily as you can in the rest of Europe. But how do they, companies that have access to that data, measure it?
So this is absolutely true. Racial disclosure is not perceived the same way globally, and some countries may consider unethical to categorize population according to their race. However, we expect this trend to evolve evolve as investors such as Calvert or the European Pension Fund introduce diversity disclosure in their top voting priorities next year and a push for more data. But as you say, there is also probably a broader set of measures that need to be introduced to tackle pay inequality, recruitment processes, and diversity in development in terms of retention along the corporate ladder. And there has been definitely challenges there, including for different types of diversity. And the one that is the most revealing, where we have number, is gender diversity.
Adeline, thanks so much for joining us this morning. Really important story that, of course, we're going to keep keeping our eyes and, of course, watching out for where we see these metrics and data going on the corporate front. Adeline Diab, head of ESG investing for EMEA at Bloomberg Intelligence. Now, coming up, how a small DNA testing company went from analyzing consumer genetics to becoming a major part of the UK's efforts to combat the coronavirus. We speak to the CEO of DNA Nudge next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, 43 minutes into the trading session, and we're looking at a drop on the CAC 40, but really little change on the FTSE and the DAX. Let's get your Bloomberg Business Flash. For that, we go to London and Laura Wright. Laura?
Thanks, Matt. For the time being, Uber made more money delivering food than it did from transporting people. But that failed to offset a steep decline in ridership. Quarterly sales fell 29%, ending a decade of growth for the ride-hailing giant. But the company is maintaining its goal of turning an adjusted quarterly profit by the end of next year. Microsoft's talks with TikTok remain focused on buying its operations in the US, Canada, Australia, and New Zealand. Sources told Bloomberg the two sides have not expanded the scope of their negotiations. It comes after a Financial Times report that the software giant was pursuing TikTok's entire business. Standard Life Aberdeen has lost its title as the UK's largest standalone asset manager. The firm saw assets under management fall to around £510 billion in the first half of the year. That takes it below Schroders. The outflows at Standard Life Aberdeen were driven by Lloyds Bank moving a large investment mandate from the company to Schroders. That's your Bloomberg Business Flash. Anne-Marie, Matt.
Laura Wright in London, thank you. Now, a small DNA testing company that just months ago was trying to get its footing in consumer genetics is now part of the effort to make UK hospitals safer during the pandemic. DNA Nudge won a £161 million offer for 5,000 machines to test patients for the coronavirus in hundreds of NHS hospitals. Its test delivers results in just 90 minutes and can also identify the flu and other viruses. Joining us now is Christopher Tumazu, DNA Nudge founder and Imperial College London professor. Christopher, thanks so much for joining us this morning. Testing has really become a sensitive situation in the UK. Thousands of tests ordered last spring turned out to be flawed. How well does your machine hold up under scrutiny?
Well, I think that one of the key advantages of the test is almost it was a solution before the corona problem existed. I've always been keen on bringing sort of standard genetics into the consumer world. And so for years, we've been looking at miniaturization, demystifying the sort of whole field of early detection and prevention. And we invented a cartridge effectively, and this cartridge has an entire laboratory inside. And this has been working, and it's been working in the field of genetics, looking at things like risks for diabetes, risks for hypertension, cholesterol, things actually that are nutrition related, which we know is also epidemic. So when it came to repurposing it for COVID, it was almost a marriage in heaven, because it was so simple compared to what we'd been doing before. Before, it was looking for genetic errors, very small differences in our human DNA, where it came to looking at the RNA of the virus, it was almost binary. You've either got it or you haven't. And so we were able to miniaturize all the chemistry, all the detection technology, so you could go directly from a swab to a cartridge like this. So very, very accurate, because it's been demonstrated before. Yeah.
It looks fantastic. I have to say, we're all impressed by the size of it, and who doesn't love gadgets? But when I hear those three letters, DNA, my Jason Bourne antennas start to shoot up, and I worry about, governments having too much information on me. What if I need to get off the grid someday? I mean, especially here in Germany, where people are so privacy oriented. How do you get around those privacy concerns, Christopher?
Yeah, so absolutely. And this is one of the reasons we brought the lab to the cartridge rather than sending your swab off to a lab. So, the traditional method is you take a swab, take a saliva, and you send it off to a laboratory. You don't know what's happening to your DNA. They could be, these companies, there are many companies, direct-to-consumer companies, that could be selling your DNA off, as you say. They could be looking for information, important information. Whereas with this technology, you do the swabbing, it goes straight into the cartridge. The cartridge then will analyze your DNA, and this gets disposed of. So effectively, it's all done in situ. So there's no laboratory, you don't send anything off to a lab, and your DNA is disposed of. So there's no genetic material, and the only thing that gets sent to either a consumer in the retail world or to the hospital now for the coronavirus test is your result. It's the results of the genetic information that are important, not the genetic information. And that's the key differentiator between our technology and others that are on the market in the sort of consumer world. I mean, obviously, we're not looking at DNA in the viral world. We're looking at RNA, which is very, very different.
Christopher, thank you for showing us exactly how this device works. Given how tiny it is, it's not as cumbersome, I think, as many people would expect. Can you see this rolling out in more than just hospitals? Will this be, a feature at businesses or airports?
Yeah, so I mean, the use case of this is really near patient. The whole point is decentralization. You know, and it's taken something like the coronavirus to sort of bulldoze the sort of healthcare system, if you like, so that things don't have to always be operated in central labs. You know, tests like this are so important. So effectively, you can get the result as fast as you possibly can without the throughput. So therefore, yeah, sure, you can go to spoke areas, not just sort of big wards. You can go into sort of care homes. We're thinking now of going into schools. So even school teachers can operate the device. You saw how simple it was. So there's nothing complicated about it. You can eventually go into emergency services, then into the sort of consumer world, as we mentioned earlier. So I think the utility of the technology and the fact that you've got no pipetting or white coats or big laboratory equipment, because we've miniaturized it all, makes it perfect for that sort of direct-to-consumer type application.
Yeah, no, it makes a lot of sense. I was thinking about flying to Spain in a couple weeks. Not sure if I want to, because the health minister here has said anyone who comes back from there has to take a mandatory test. This would, of course, make it so much more convenient. Have you got enough funding to scale up? Because it seems like you could scale way up with something like this right now.
Yes, so as you mentioned at the start, I mean, we were a sort of consumer technology business, really trying to demystifying genetics and bringing it into the consumer world in a very friendly way. And it's to do with diet and nudging people to eat better based upon their DNA. And that's how we began, and that's been going quite well. We've raised Series A money, and we've established a business, but now we're effectively trying to scale innovation at the speed of light. And so we're confronted with this sort of bulldozer now of a business, which we've got to manage. It's almost that we've bulldozed the healthcare system with something that was unusual for them. And now we're sort of mopping up and trying to get into that environment. So the funding, you know, will take us to a point where we can get some very, very early revenues. But obviously, we're selling to the NHS at cost. This is not a big money-making exercise for the business. But the private sector is queuing up as a result of the publicity we've been getting. And that's where we can start making margins. And I think, therefore, you know, sort of investment should hopefully come quite naturally as we start building up into the private sector.
All right, Christopher, thanks so much for spending some time with us this morning. Very fascinating device there at a time when something like that surely is needed. Christopher Tommaso, DNA Nudge founder and a professor at the Imperial College London. Up next, gold already boasts several qualities that enhance its allure: a hedge against inflation, sometimes a haven asset. Why MLive's Van Ram thinks we need to add one more to the list. This is Bloomberg. Welcome back to the European Open. We are almost an hour into the session and looking at pretty much little change with the exception of the drop of 0.5% in Paris. Gold already boasts several qualities, as we told you, that enhance its allure. It's shiny and yellow. It's a hedge against inflation, sometimes a haven asset. And Bloomberg MLive currency and rate strategist Ben Ram thinks we ought to add one more to the list. He joins us now to tell us what it is. Ben?
Morning, Matt. That one missing ingredient that's not been added to the list so far is convexity, which obviously is a second-order derivative. It's a very fancy way of saying gold has got more upside when real rates tumble and less of a downside when real rates actually go up. So I did a study of the price movements of gold in relation to long-term real rates in the U.S., and that's what that study shows. What are the implications of the study? It shows that gold can reach $2,500 an ounce if real rates tumble by another 100 basis points from current levels. On the other hand, gold will only fall to $1,700 an ounce if rates go up by 1 percentage point.
Ben, we're going to have to leave it there. We're all out for time of the show. Ben Ram, our MLive strategist. Catch his column today on the terminal, though. It's great. That's it for the European Open. And for me, Anna Edwards is back next week. Thank you, Matt Miller, for having me these last 2 weeks. Stay with Bloomberg Television. Up next, it's Surveillance. This is Bloomberg.
President Donald Trump signs executive orders blocking U.S. residents from doing business with TikTok and WeChat. Shares in WeChat owner Tencent plummet. No deal. The White House and Democrats failed to agree on stimulus. President Trump's chief of staff says the differences are still significant. And it's Jobs Day. July jobs figures are out later as a return of lockdowns and uncertainty weigh on the U.S. labor market. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, this is what the markets are doing. We're also getting some breaking news out of China. This is for end of July foreign exchange reserves coming in at $3.1 trillion. The estimate was 3.14, so it's a touch above that. The market's focusing, of course, on some of the data in the U.S. The market's also focusing on the stimulus in the U.S. that may or may not be coming. Now, President Donald Trump's latest attack on Chinese companies also stoked tensions with Beijing, which is why we're seeing treasuries and dollar actually rising. The president signing an executive order prohibiting U.S. residents from doing any business with WeChat, TikTok, or the owners of these Chinese apps. Now let's get straight to the Bloomberg First Word News. Here in London is Laura Wright. Hi, Laura.
Thanks, Francine. There's been no headway in talks between the White House and Democrats over a new virus relief package. There are still major sticking points, and both sides are accusing the other of refusing to compromise. One key difference is the top-line number. The Democrats want $3.5 trillion of aid. The Republicans want $1 trillion. Another round of monetary stimulus is expected from the Bank of England. Policymakers yesterday said the hit from the coronavirus was shallower than initially thought, but that upbeat assessment was lost on the markets, driving the doubts and expectation for more flare-ups of the virus and a messy Brexit. Governor Andrew Bailey, speaking with Francine, said he's ready to support the economy as necessary.
There is a very big downside skew. I think there's a lot of hard work to be done to get the economy back to where it was. We've had quite a rapid recovery so far, which I'm not surprised about as restrictions get lifted. The reason that we issued the guidance, in my view, was to say, look, the forecasts can sometimes look beguilingly sort of, straightforward. There's an awful lot of risk in there, and it's obviously distributed one way. And we will be therefore ready to lean in, as it were, and support that.
UK Prime Minister Boris Johnson has pledged £355 million to help with Brexit red tape in Northern Ireland. It will fund a service to complete the declarations on goods crossing the Irish Sea. The government repeatedly said there would not be checks on goods from Great Britain to Northern Ireland, but the announcement of a programme to pay for the paperwork confirms there will be. There are still hopes for a speedy economic recovery in Germany. A rebound in manufacturing is starting to catch up with the services sector. Industrial output gained nearly 9% in June. That follows on from figures yesterday that showed factory demand is rising. It suggests Europe's largest economy may bounce back more quickly than its neighbours. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, Trump moves to ban TikTok and WeChat. The U.S. president signed an executive order prohibiting U.S. residents from doing any business with TikTok or its Chinese owner, ByteDance, beginning 45 days from now. Then he did the same for the WeChat messaging and payments app. Well, let's focus in on how the U.S. Sino tensions are moving markets. Joining us now is Andrew Sheets. He's Chief Cross-Asset Strategist at Morgan Stanley. Andrew, great to have you this morning. How does this escalate, or does it escalate?
Well, I do think that you have a really, I think, tricky period that we're heading into ahead of the U.S. elections, where you have the ongoing question of compliance with the Phase 1 trade deal, which is an open question, and where we'll see another meeting later this month. But also, I think an election where trade policies towards China is likely to be an election issue, where I think actually both candidates are out with a message that they think that they will be relatively tough on China vis-a-vis trade, and where you have an ongoing risk that if the Trump administration feels like their current message on trade is not working with the electorate, that maybe they'll try to change that. Maybe they'll try to become more aggressive or switch it up in some other way to gain more traction. So I don't think this is maybe the biggest news of the day. I think probably the jobs number and the stimulus package, as you mentioned before, are likely to be bigger market movers. But it's a very important ongoing issue, and it's something that's going to be with the market over the next several months.
Andrew, does it get worse from here, or is this really only election rhetoric?
Well, I do think how the reaction of the phase one deal goes is important because, you know, I think at the end of the day, you could say that this is limited to some individual companies, a very specific issue. But I think the perseverance of the phase one deal is a much kind of bigger issue, right? You, I think, have seen in some cases some of the purchases of agricultural material from China slow or be a little bit behind schedule. You've obviously seen kind of ongoing rhetoric from both sides, and so given that the phase one deal was supposed to be the easy part, you know, that both sides put kind of all the issues they had previously agreed to in the phase one deal, if that is running into trouble, then I think it would suggest kind of far less progress down the line, and I think far more kind of extended risks even beyond any election.
So, Andrew, what does it actually mean for the markets? What would you be buying right now? And if you look at the way that, you know, gold has been doing but is now correlating maybe with, you know, things that we've seen in equities, does it mean that its ascent will be stopped?
Well, I actually think at the moment, I think looking into August, September, the question is more about, you know, selling than buying. I think this is a good opportunity for investors to reduce some risk. We have been more optimistic in our allocation. We've been, you know, lowering that. We've recently lowered that exposure, and I think a big reason in part is part due to the strong recent gains that we've had, and in part due to the fact that the coronavirus is spreading worse than our initial forecast expected, and then that you do have some, I think, very kind of specific risk events that are looming over the next several months, whether it's on trade, whether it's on the stimulus package, whether it's on other factors. So I do think it's an environment where I think it's looking tougher for markets. I actually do think corporate credit looks relatively better in that context, given we actually think the supply of new corporate bonds is going to slow a lot over the next several months. So that could lead to a relatively attractive supply and demand balance. But I think overall we're expecting a much choppier market over August and September.
Choppier because of coronavirus and tensions, or just because people are positioned where they shouldn't be?
Well, I actually think it's a combination of both. That I think you have the removal of some of these positive catalysts that we've recently had, whether it's been earnings season or the European Recovery Fund. I think it's the emergence of, I think, some new risks, whether it's a trade policy with China, whether or not it's the U.S. election moving closer, whether it's the fact that the second stimulus bill in the U.S. does appear to be running into some trouble. And then I think, you know, to your earlier point on positioning, I think what's just very interesting, and I think this really links a lot of market themes together, is I think actually a lot of investors have all moved to very similar positioning, in the sense that they are overweight or favoring things that benefit from lower yields and lower real interest rates. And that could be, you know, the NASDAQ in the U.S., that could be gold. I mean, both assets are behaving in very similar fashions. And so I think if one's view is that rates will continue to move lower, then gold will be a great asset, and that the NASDAQ will be a great thing to hold. But I think it's important to acknowledge that, you know, something like gold might not be as much of a diversifier for a portfolio as people expect it to be. That given how it's reacting, it's behaving more like the NASDAQ.
Yeah, Andrew, thanks so much. Andrew Sheets there from Morgan Stanley stays with us. We'll talk about stimulus in the U.S. We'll also, of course, talk about jobs in the U.S. Now, coming up, negative rates are part of the toolbox, but there are no plans to use them yet. That's the view from the Bank of England Governor, Andrew Bailey. We'll bring you our interview a little bit later in the program. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg Business Flash. Here in London is Laura Wright. Hi, Laura.
Morning, Francine. For the time being, Uber made more money delivering food than it did from transporting people. But that failed to offset a steep decline in ridership. Quarterly sales fell 29%, ending a decade of growth for the ride-hailing giant. But the company is maintaining its goal of turning an adjusted quarterly profit by the end of next year. Long the number 4 in the US wireless market, T-Mobile is officially number 2. Its merger with Sprint had helped the company overtake AT&T to reach over 98 million subscribers. It expects to add up to 1.9 million new monthly customers this year. First place Verizon has about 119 million customers. Standard Life Aberdeen has lost its title as the UK's largest standalone asset manager. The firm saw assets under management fall to around £510 billion in the first half of the year. That takes it below Schroders. The outflows at Standard Life Aberdeen were driven by Lloyds Bank moving a large investment mandate from the company to Schroders. And that's your Bloomberg Business Flash, Francine.
Thank you so much, Laura. Now, Congress is still struggling to agree on a new stimulus deal a week after the $600 a week payment expired. Republicans are looking to President Trump to take executive action, but House Speaker Nancy Pelosi slammed the offer from the administration as not going far enough. While further delays to fiscal support could exacerbate the spike in Americans leaving the labor force, applications for U.S. unemployment benefits unexpectedly fell last week to the lowest since March. But the July jobs report out later today could also show the effect of further lockdowns and uncertainty. Well, still with us, Andrew Sheets from Morgan Stanley. Andrew, how do you see this planning out? First of all, are we going to get some kind of stimulus package? And if there's a self-imposed deadline of the end of this week, if we don't get it at the end of this week, does it then kind of die down, or could we get it, a week or 2 weeks from now?
Well, look, I think a lot of the risks here, I think, are really kind of negatively skewed. So first, we don't know exactly where the negotiations stand, but all the indications are that, agreement on any major part of the deal still remains elusive. So these are talks that are still a long ways away from reaching an agreement. And I think the indications that the administration might try to address this with executive actions, while it might sound initially attractive, I think is also a potential problem, because if that happens, you might remove some of the impetus to reach a larger deal. And in that case, you could really miss out on the types of stimulus that I think are in our economic base case and a lot of people's economic base case. And I think that's especially true for state and local government funding, right, which is, I think, a huge part of this story and a huge part of what happened in 2009, 2010, is that state and local governments, they employ a lot of people, and they are counting on, they need further support from the federal government. If that's not forthcoming, then you could see a second round of layoffs, a second round of fiscal tightening out of state governments that could really hold back the economy.
So if you look at regions, the U.S. versus Europe, how much does that put the U.S. economy on the back foot? And again, what does that mean for your strategy, Andrew?
Yeah, so I think this, and again, I think this is, as you mentioned, a live situation. So we'll know a lot more in 24 hours, both from the labor data and from the DC negotiations. So one has to be somewhat flexible here, but I do think these are risks that are skewed against the U.S. And I think if you look at the U.S. versus Europe, I think Europe does have a better handle on the coronavirus. I think the European data has been recovering more strongly in many places than the U.S. data, and Europe kind of doesn't have this big kind of overhanging uncertainty of a U.S. election. So I think that's generally relatively favorable to the European story. It's been one of the reasons why we've been constructive on Italian bonds versus German bonds, been constructive on the euro, and I think on the equity side, see better risk reward in European stocks here than U.S. equities.
What do you do with dollar?
Yeah, we think the dollar continues to weaken against the G10. That's been our view. That continues to be our view. And I think it's for a variety of reasons. I think the dollar remains relatively expensive. The dollar has really, I think, lost two big reasons to own it. One was this idea that the U.S. economy was this very strongly outperforming economy, and I think that's not been the case, or that's no longer the case to the same extent. And then, the U.S. market had this great yield advantage. It was where investors could go to get the highest interest rates. And again, on a inflation-adjusted basis, that advantage that the U.S. has really been falling. So, I think for both those reasons, that's undercut some of the reasons to own the dollar, especially own it at relatively expensive valuations. And so I think over the next 6 to 12 months, we still expect it to weaken.
Andrew, if there's, and I think I ask you every time, and I always, see if there's a different answer, but is there anything in a bubble right now? We look at the tech, and I think it's what we were talking about last time you were on, but then actually they came out with stellar earnings. Is there something that makes you nervous about where the market is headed?
Well, I think that, as we mentioned actually just before the commercial break, I think the real kind of challenge in the market is I do think you have a number of different assets that are all very sensitive to interest rates, and especially kind of real interest rates, at a time when those interest rates are very, very low, really at some of their lowest levels ever recorded. Now, in some cases, like with technology, there's still a strong fundamental story there for the time being. In some cases, central banks have articulated an extremely accommodative policy. But, I think any time you have a lot of market sensitivity to something at its kind of most expensive ever valuation, I think that should be naturally, concerning. And so I do think that, as we kind of step outside a little bit of the next, the view over the next, week or month, that I think, big picture, you have, I think, central banks that need to be actually, I think, somewhat careful in that they're not making investors too confident about owning a lot of exposure to something at kind of exceptionally expensive valuations.
Could you buy VIX right now, or would you buy VIX?
I actually wouldn't on the VIX side because I think actually, on the volatility is really fascinating because actually stock volatility has remained stubbornly a little bit high, but I think actually interest rate volatility is very attractive here. It's very low, and as we just mentioned, I think it's actually interest rates that are kind of the key here. If they stay where they are, then the market's fine. If they move more, then that could be a lot more disruptive. So I think interest rate volatility, foreign exchange volatility, those are the two most interesting markets for investors looking to own volatility exposure.
Andrew, thanks so much as always. Andrew Sheets there, Chief Cross-Asset Strategist at Morgan Stanley. Now coming up, the lira tumbles, hitting record lows in a sharp decline. We're live from Istanbul with the very latest. That's coming up next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we've been talking quite a lot about the executive order about that President Trump put on TikTok, but also WeChat. TikTok now saying in the last couple of seconds that they will pursue all remedies available on that Trump order. So we'll see whether there's an escalation of this or where this goes, but certainly it took the markets a bit by surprise as it seems that the escalation between the US and China is firmly back on the agenda. Now, if the options market is any guide, Turkey's lira is for a rough ride. Traders bet for volatility in the next month, jumped by the most since March 2019, and the risk reversal shows the biggest demand in 3 months for buying dollars against the lira. The currency fell to a record low on Thursday despite intervention by state banks. Well, joining us now for more is Onur Ant in Istanbul. Onur, why exactly is the lira weakening so much?
Well, the lira is now down for the third day in a row, which took the Turkish currency to a record low against the dollar. The depreciation is fueled by a massive credit boom that resulted in a widening of current account deficits as well as a growing demand for dollars by residents and corporates. And that's because historically low real interest rates offer little incentive to keep savings in the local currency.
So, Onur, what are authorities doing to stem the slide? I mean, they've tried a couple of things, but actually it hasn't worked.
Well, you're right. They've done a variety of things. I mean, surprisingly, state banks, which have been defending the lira with dollar sales, pretty much abandoned the market as of yesterday. That is kind of unexpected. You would expect just the opposite, but they seem to have ceased to follow that policy of trying to defend the lira with dollar sales. And in addition, the banking regulator is now easing restrictions on lira liquidity abroad. That effectively allows foreign banks to access lira liquidity like they used in the past. And they're also rolling back regulations that force lenders to boost credit. So overall, I would say regulators seem to be leaving behind the policy mix that they had for the last 2 years or so, and they seem to be trying to portray it as a normalization process in Turkey's economic policy.
So what does it mean for international investors, Onur?
But it means, first of all, it means for foreign banks especially, it will be easier to access lira liquidity after they have been pretty much cut off from the offshore lira market for almost a year now because of the regulatory decision. Now, having said that, the lira has been in a free fall in the last few days, so usually it takes the stabilization of the lira for foreign investors to start and rethink their positioning in Turkish lira assets.
Onur, thank you so much for joining us. Onur Ant there with the pretty incredible move that we're looking at Turkish lira. I know Tom Keene is also very keen to talk about this currency, so we'll have plenty more on Turkey throughout the day. Now, coming up, the world's biggest precious metals ETF now holds more gold than the Bank of Japan. We'll dig deeper into the gold story and Europe's exchange-traded fund markets. That's coming up shortly, and this is Bloomberg. another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get the latest on Europe's ETF market. For the first time this year, there were net flows on both fixed income and stock exchange traded funds in the euro area in July. Now this week in the US ETFs, they hit a record with holdings reaching $4.6 trillion, finally surpassing their pre-pandemic peak. Now something else which keeps on setting records, of course, gold. ETFs have now increased their holdings for 30 straight days, and the world's biggest precious metal ETF now holds more gold than the Bank of Japan. Well, with all of the details is our Danny Berger. Hi, Danny.
Hi, Francine. Yeah, these ETFs really hoovering up assets. It's no surprise when you have negative real rates in the U.S., you have geopolitical tensions, a health crisis, and the weakening dollar. People are turning to gold, and they're increasingly doing it more through these exchange-traded vehicles. So State Street's SPDR ETF, ticker GLD, is the most popular among the bunch, and it's added 50% more of gold holdings over this past year. In the past week, in the first 3 days of the week, it added 26 metric tons of gold. That puts its holdings above a lot of central banks. It holds more than Switzerland and the BOJ, and if it continues on this trend, it could be in striking distance of the PBOC. And this week, it's also become the most popular ETF in the world. That's in terms of inflows. It's taken in more than $21 billion worth of inflows. That beats out Vanguard's S&P 500 ETF and iShares investment grade ETF as well. So certainly a lot of popularity here.
So, Danny, is there any danger with having investors bet on gold through ETFs?
Well, it certainly would depend who you'd ask. A lot of the ETF providers say that it's a helpful mechanism to have ETFs to be able to buy and sell them through gold. It might take some of the pressure off on the underlying market. But according to Cam Harvey, who's an advisor at Research Affiliates, he does take issue with this growth of gold ETFs. He calls it the ETF financialization of gold. And now we're seeing, he says, a direct correlation between the price of gold and the holdings of these ETFs. And because they're so correlated and these are instruments that can be bought and sold very quickly, we might see more peaks and troughs in the price of gold. He also says that much like you see it in stocks, because of these ETFs, you can now see irrational exuberance within the gold market, Francine.
Danny, thank you so much with great reporting there, our Danny Berger. Now joining us to talk more about this is Howie Lee. He's head of ETFs at LNG. Howie, great to have you on the program today when we go back to looking at ETFs with a bit more gusto. When you look at what's exactly going on in gold ETFs, are we just going to see a lot more of these flows?
Yeah, look, as long as the market volatility and the uncertainty is there, it's not going to be a surprise that investors will look to gold, whether it's in gold, physical gold like you see in those ETFs, or even gold mining stocks. There are opportunities to be had. That being said, what everyone's probably waiting for is to understand, well, when's this volatility going to end, and when are we going to see a little bit more certainty? I think if you look at historical events, gold has always been seen as a store of value and a flight to safety.
So what does it mean for ETF providers, Howie? Have they been doing more gold ETFs? How will it change the actual market?
Yeah, look, we don't expect the ETF or ETFs or the ETC structures to change the gold market at all. Bearing in mind, ETFs are just doing what they're supposed to do, which is to track the underlying asset. There are many people buying gold in other ways, whether they're through futures. ETFs is just another way to access them. Very easy, whether you're an institutional investor or a retail investor.
What can you tell us about how ETFs have actually been affected in the volatility that we saw over in March, and what that means for the markets in the future? Did they play a kind of a soothing role, or did they exacerbate some of the moves?
Yeah, no, we're definitely not of the view that it exacerbated the moves. What the ETF vehicle did is really just give a lot more transparency as to what was happening in the underlying markets. If you can imagine, a lot of times when we look at traditional pooled funds, we get a pricing for the value of those funds once a day, whereas ETFs, they're traded all the time throughout the day. And what ETFs have been able to do is almost give you a sense of what the underlying liquidity is in the market. And I think back in March, there was a big spotlight shone into fixed income, into bonds. But then at the end of it, you even had, the Bank of International Settlements confirming the fact that, in fact, ETFs did what they were meant to do, and really this was just transparency and real-time data that was coming to the market. And it's a fantastic kind of place to be for investors to be realizing and understanding a little bit more.
Howie, is Europe ready for active ETFs?
It's a great question. Now, bearing in mind, your active ETFs already do exist in Europe. I think one of the big questions, of course, is whether non-transparent active ETFs should be hitting the market. Now, I'm very much of the view that active or passive, they all have a role in the market here. And really, they should actually be allowed to trade on exchanges. Because at the end of the day, this is about access. And if accessing an investment strategy, whether it's passive, whether it's active discretionary, it should be about the ease of buying and selling those investments for investors, but also the transparency and the real-time pricing that are able to provide.
Howie, talk to me a little bit about the trends that actually COVID-19 has changed. So, we were talking about the fact that this is not really a misplacement or a crisis like it was in 2008. It's just accelerating trends that was already in the market. So I don't know whether that's, probably, healthcare via apps or, technologies, cyber security, things like that, and what role ETFs can play into spotting the trends and playing these trends.
Yeah, it's a great observation there, Francine, because what COVID-19 has been able to do is shine a spotlight into some of these newer sectors that are coming, into the forefront. Before, when we were speaking to investors or clients about cybersecurity, let's say 4 or 5 years ago, it wasn't as obvious. E-commerce was another thing that we had started talking to investors a lot about, what is happening in the e-commerce logistics sector. And of course, when lockdown happened, people started to realize and also feel real time how this was going to effectively change their life, looking at some of these tech solutions, looking at how things were going to be delivered as easily as possible. And of course, healthcare solutions being at the forefront of this. We've been talking to investors about telehealth and the fact that you can actually solve a lot of problems just remotely by essentially being able to consult patients through digital means rather than clogging up the healthcare system through traditional kind of in-person meetings with doctors.
What about ESGs, Howie? How has that changed in the ETF world?
Well, I think that's definitely going to be an evolution. If you asked me this question 3 or 4 years ago, ESG was something that a lot of investors perhaps didn't really consider too much. But all of a sudden, every single meeting has an element of ESG here. And what we certainly see is that ESG is going to be integrated into all types of investment strategies. And it will kind of leave a lot of existing strategies that don't consider ESG potentially not as attractive or not as interesting to investors. As you can see in some of the numbers that come through, more and more products that are being developed are indeed focusing on at least excluding investments or stocks that are not deemed to be suitable in a portfolio. But more importantly, we're now seeing investors having the appetite to really allocate capital towards companies which are essentially scoring better or having a much more effective approach to ESG. And for us, another component within ESG investments, whether they're ETFs or traditional funds, the engagement with these companies to get them to really behave better and think more importantly about corporate governance, et cetera. Those are really kind of important developments that I think are here to stay.
Howie, I mean, a question that we often get from market participants is actually ESG was a lot on sustainability. How do you play diversity through ESG, and how does that work in ETFs?
As it relates to diversity of a portfolio, obviously a multi-asset approach is extremely important to have, whether you're holding just a collection of bonds or equities. And a lot of our investors, truthfully, hold both ETFs and traditional funds. And the important thing here is always to have a diversified portfolio, but also, more importantly, to make sure that we're keeping an eye on the future. So ESG, of course, is looking forward as to where future capital is going to be allocated to, how people think about ESG. Same as long-term themes, it's trying to identify tomorrow's sectors rather than looking back to see how our businesses or how our industries were developed in the past. So everything that we certainly believe in is to really look into the future and understand where the opportunities are. And that's really how we believe a lot of ETFs going forward should really construct their portfolio.
Howie, thanks so much for a terrific briefing. Howie Lee, they're head of ETFs at L&G. Now, coming up, negative rates are part of the toolbox, but there are no plans to use them. That's the view from the Bank of England Governor Andrew Bailey. We'll bring you our interview next. This is Bloomberg. Watching Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's turn to ESG, and in particular the S, which has risen in prominence in the last few months. According to Bloomberg and the MSCI data, European companies with the highest ESG rankings, in particular social, outshone the broader market. Now, following on from the push to get more women on company boards, investors now want to see greater ethnic diversity, and companies have pledged to do better on racial equality. So, what steps can they actually take? Well, Adeline Diab, head of ESG investing for EMEA at Bloomberg Intelligence, joins us now. So, Adeline, first of all, how much has that changed in the words of investors? ESG used to be a lot about climate change and sustainability. Is it now, more about diversity also in the workforce?
Hi, Hi, Francine. Yes, we've seen the rise of the S in the last few months with the global pandemic and the Black Lives Matter movement. And the good news is that ESG has outperformed. ESG indices have outperformed for the second straight year and done particularly well during the crisis. The MSCI US, Europe, the emerging markets, ESG leaders indices have all beaten their benchmark in the first half of the year. And their outperformance is partly due by the indices factor exposure, which tends to be about mix of low volatility and high quality stocks. But and so they provided a downside protection during the market turmoil, also because of ESG tending to invest or cherry pick companies that are extremely aware of ESG issues and so are being more inclusive, agile, and responsive in the crisis. And at Bloomberg Intelligence, we developed a framework which is called the Corporate Pandemic Response Tracker to help investors navigate that. The second point I'd like to make actually on performance, or more actually on flows, following on an earlier segment, is that ESG ETFs have seen inflows. And interestingly enough, over March and April, their flows were mimicking gold, which sent a very strong signal because there were the only two asset classes to see ESG ETFs to see inflows.
Adeline, thanks so much for joining us. Adeline Diab there, of course, from Bloomberg Intelligence, where she's head of ESG investing. Now, the Bank of England says it won't tighten policy anytime soon, despite the UK economy showing signs of a faster rebound than initially expected. Governor Andrew Bailey told us negative rates will be part of the bank's toolbox, but at the moment, there are no plans to use them. Well, we spoke after policymakers voted unanimously to keep the benchmark interest rate at a record low 0.1%.
The things we've looked at are broadly further QE, further quantitative easing, potentially use of negative rates, and forward guidance. Those are the things that we've looked at.
So yield curve control has not been discussed, or is it something
I mean, obviously yield curve control is quite interestingly discussed in central banks, and we do discuss it. It's something that, I mean, we've preferred to look at quantitative easing and forward guidance as tools in that respect. But I would make the point that we will go on looking at the toolbox. You know, nothing is fixed down forever, but it's not in our planning at the moment.
What would it actually take for you to go into negative rates?
The issues that we most focused on, and we've talked a lot to the central banks that have done them. Those have gone in, come out, gone in, not yet come out. Really very, very helpful and fascinating conversations, lots of the work they've done. And I'll draw 2 points out of it. One, as you get into this territory, there is, I think, a much bigger interaction with the structure of your financial system, and particularly the structure of your banking system. Nobody has really sent retail deposit rates negative, and I can understand why. Obviously, it means that the bigger the share of retail deposits in your banking system funding, the more attenuated the effect of negative rates will be. We've actually got quite a high share of retail funding in the banking system, so that's one thing. The second thing that I would conclude, looking at the experience of some of the other central banks, is that the effectiveness of negative rates does depend upon what point in the cycle you're using them at as well. And again, that's an interaction with the financial system as well.
But so would you see yourself using negative rates, post-COVID, so in a recovery phase, to actually help the economy then?
Well, I don't know is the answer, because we're not facing that situation today. I think it is true that I think when you look at the experience of other countries, they appear to have worked more effectively in the recovery phase. Now, I would, however, qualify that a bit by saying I think there's a tricky identification issue at that point as to what extent it's negative rates that are driving, for instance, the recovery of the banking system, the lifting of the release of provisions, and therefore the ability to lend, and to what extent that would have happened anyway, because it's a cyclical point. It's a rather tricky issue in that respect. So the evidence is there, but it's a little bit hard to identify the causes.
But then again, in terms of sequence, it's not something that you would rule out, right? It could happen at that phase.
Oh, definite message we're giving today is, look, they're in the box. I mean, there are other central banks that have said they're not in the box because, again, their financial systems have got different properties and they draw different conclusions, so I can understand that. They're in the box. We're not considering using them at the moment.
Well, that was the Bank of England Governor Andrew Bailey speaking to me yesterday. More on the markets, so that's coming up shortly. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the pandemic has dented demand for electric vehicles, but the world's biggest EV battery maker sees sales showing resilience. LG Chem Chief Executive Hak-Cheol Chin spoke exclusively to Bloomberg.
Yeah, obviously we saw some impact, especially in the first half, especially in March, April timeframe. For example, United States, China, those countries. But we have seen robust demand coming from European countries. We have actually not seen any slowdown in European demand. And we have some more production to boost in the second half of the year. So we do not have a complete tally yet as far as total year production is concerned.
Right.
But I think it will be either very close to our projection originally that we have had, or if there's any impact, it will be relatively small.
Any of the things that you're hearing that you just mentioned there, or any other things that you're probably seeing recently, making you rethink your targets for production capacity for the battery business? I believe the initial one was 100 gigawatt hours this year. That goes up to 120 by 2021. Do you need to look at that and maybe increase that, or does that still make sense to you?
Yeah, pretty much we stick to our plan to continue to invest in our capacity. As you mentioned, we have about 100 gigawatt capacity by the end of the year. But by 2022, we should have about 220 gigawatt capacity. I think the penetration rate of EV is still relatively low, about 2.6% last year. This year, maybe about 3%. Even with the robust market growth of about 40% for the next 5-6 years, we have to continue to invest in our capacity to secure that over 220 gigawatts by 2022. As you know, we have unfulfilled order book of close to $125 billion. So that's a lot of batteries to be made.
Your capex plans for the next, is it still 5 trillion won for this year? And since you mentioned 2022, do you have a figure already of what you plan to spend next year and the year after that?
I think in battery alone, we will be spending about 3 trillion this year. There was the same or even slight increase from what we had in the plan. And I think that ratio of capex will continue in years to come.
The market's taken a look at your stock and has you obviously would know as well that your stock has gone up substantially. I think you entered either the top 5 or you were the top 6 largest company on the South Korean exchange at some point. A lot of that had to do with speculation that the partnership with Tesla and the battery business is doing quite well. Can you tell us a little bit more about how that engagement is going now, what you're looking forward to, and how you actually plan to fend off competition?
We should be able to secure a production capacity of roughly about 25 gigawatt, which is equivalent of about 400,000 EVs by the end of this year. So I think we are very well poised to meet the demands of various customers, including the customer that you just mentioned.
Okay. Fair enough. What's your assumption then on how quickly you think the battery business overall will grow every year, and you expect as a company your sales will exceed that industry growth?
Yeah, I think we expect about $13 trillion from our battery business this year. They will grow to about $30 trillion by 2025. There's a very robust market growth driven by, again, emission regulation and government policy. So I think our battery business will at least grow at the speed of the market.
Okay.
Our goal is to either maintain or strengthen our market position in many years to come. So we hope to grow faster than the market.
Well, that was the LG Chem Chief Executive Hak-cheol Chin. Now, the markets are focusing, of course, on what's happening in the U.S. with the stimulus. That is not exactly going to plan, but we'll see if there's a 11th hour agreement. And, of course, there's U.S. jobs data as well. Bloomberg surveillance continues in the next hour. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. President Donald Trump signs executive orders blocking U.S. residents from doing business with TikTok and WeChat. Shares in WeChat owner Tencent plummet. No deal. The White House and Democrats failed to agree on stimulus. President Trump's chief of staff says the differences are still significant. And of course, it's Jobs Day. July job figures in the U.S. are out later as the return of lockdowns and uncertainty weighs on the U.S. labor market. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keene in New York. Tom, it's really D-Day because it's Friday, and we were hoping to have a bit more of an agreement on the stimulus package. And now it just seems that, you know, we could not get anything by the end of the week. And again, a lot of the benefits that a lot of Americans have expired.
Well, it's D-Day in the sense of depression. Ringing in the zeitgeist right now is Reinhardt and Foreign Affairs magazine, Francine, calling it the pandemic depression. We're going to learn a lot more about that at 8:30 this morning. And I'll tell you, there are people that have gloom. There are people in the middle. And Francine, there is a sizable group saying, forget about it. There's some real momentum in the economy. We'll have to see.
Yeah, we'll have to see, and we'll also look at inflation forecast. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom. President Donald Trump is moving to ban TikTok and WeChat in the U.S. He signed executive orders barring U.S. residents from doing business with the apps. It also applies to transactions involving TikTok owner ByteDance. But the order against WeChat isn't as expansive and doesn't amount to a broader ban on dealing with its owner, Tencent. TikTok says it is shocked by the order and will pursue all available remedies. The U.S. is looking to tighten rules for Chinese companies listed on American exchanges. A presidential working group on financial markets is recommending the SEC strengthen the regulations around disclosures and auditing. The group didn't determine how to enforce the guidelines, but the final penalty for companies that don't comply would be a delisting. And in Hong Kong, plans to offer free virus tests to all residents. That's according to local media. The move reflects a boost in testing capacity with help from mainland China. There's been no headway between White House and Democrats over a new virus relief package. There are still major sticking points, and both sides are accusing the other of refusing to compromise. One key difference is still the top-line number. The Democrats want $3.5 trillion of aid. The Republicans want $1 trillion. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. The churn before a big jobs report, no question about that. Nice lift yesterday to equities. We pull it back right now, but I don't want to make a big deal about that. Yields are in. We're going to talk about that in a moment with Stephen Major of HSBC. Oil churning. Churning is the word for the moment. I would say that one of the nuances that's out there is stronger euro against weaker yen. You see that with euro yen going out to a 125 strong euro weekend. Francine, I'll let you talk about the Turkish lira. It's weaker.
Yeah, it's weaker, Tom, and actually you were way up front on this because you've been mentioning it for the last couple of days. We also had a terrific briefing by Onur Ant exactly talking about the forces at play. I mean, if you look at the charts, it's pretty incredible, and, you know, we also have a great story saying it's a perilous game with financial markets reaching crossroads, lira tanking again. What also I'm looking at is, look, gold. So it's not ever higher. Again, there's a lot of questions, Tom, on what gold is behaving like, because it's tracking some of the stocks in the U.S. and it's maybe not a safety play like it was 3 or 4 weeks ago. It's all about the tech tension, and you're seeing European stocks down 0.2%, Tom.
We begin an eventful Bloomberg surveillance across the span of this day, and we start strong with Stephen Major of HSBC. One of the hardest things to do is to be right and then continue with your call. It is so easy to take the victory lap and move away, and Stephen Major's never done that. No one of the major bond strategists has nailed lower yields like Stephen Major. Stephen, Jan Loeys over at JP Morgan is on the same page as you. He has a foundation which is a vector of the 10-year yield to 0% and even below. You're in the sweat of actually making calls. Can you get on board his theory and say we can still see a grind of persistency to a lower U.S. 10-year yield?
Yeah, our forecast is at 50, and I think it can go below the forecast. Tom, if the yield is below our forecast, doesn't mean to say we've got to change it. We're not nowcasting. I think that we could see the lows for the year trade. So that was 31 basis points intraday back in March. People are focused on the real yield. I hear a lot of it on the show. My approach is different to many others. I look at real yield as an outcome, and it's a simple calculation. It's nominal yield minus inflation. It doesn't mean anything. And people need to let go of the prejudice they have. People seem to think the real yield is meaningful. It's not. Look at real yields in the UK. They're -3. They've been -2 to -3 for as long as I can remember. US yields at -1, they could easily go to -1.5, they could go to -2. It's all possible. So, let go of this idea that the negative real yield is some kind of constraint. It's not. It can go lower.
What is so important here, folks, and you heard this from John Riding of Breen Capital, of course, years ago at Bear Stearns, the same idea, and the phrase that Mr. Riding used was residual. My first project, Steve Major, at Bloomberg, was try to explain the residual to people and frame it out in the terminal, etc. What's the nominal yield going to do? I mean, the pressure is there, and there's a belief that the central bank can control the nominal yield. Can they?
Look, I'm so pleased you've said that, Tom, because to me it's controversial for some people to understand this. If the policy rate is 0 and the 10-year yield is 50, that's like saying for the 10-year rate, well, you could have 5 years at 0 and then 5 years at 100. The average is 50. That's all that's saying. That's not wrong. That reflects a realistic outcome for nominal rates. If the inflation expectation moves up to 2, where the Fed wants it, or beyond, the real yield is going to become 50 minus 2, minus 150, residual. And in reality, people trade bonds, nominal yield bonds, and swaps and futures. The proportion of trading in inflation-linked is tiny. So to me, there's a practical explanation, there's a mathematical explanation. You're completely right. It's just an outcome.
Stephen, how much lower can they go?
Well, we can get nominal yields down towards the low for the year. We have seen 30, 31 basis points intraday. That's below our forecast. They could go even lower, Francine. It just depends. If the Fed wants to guide policy rates at 0 for even longer than they are at the moment, it would be correct for 10-year yields to go towards 0. And that's what's happened in Japan, isn't it? Now, I think one of the problems is everyone looks at it and says, well, it's too low, therefore it has to go up, which, by the way, is not rigorous analysis. I see people all over the world doing and saying the same thing. Oh, we've never seen yields so low. The real yield is negative. Surely next year it will go up. That is not analysis. That's just some kind of guess based on mean reversion. It looks to me that low for longer is in as the base case. So let's get used to it and let's start to build a process around it.
So what is the process around it? What are in this new world, Stephen? What are your conditions?
Well, we can work very well with negative real yields. The bond market's been functioning for the last 10 years in Europe and Japan with negative real rates and now negative nominal rates. I think it's fair to say that it reprices credit, and it may well reprice some of EM. It is supportive, I think, for equities as far as we can see, because you have to look at the assumed discount rate. But it's not as simple as I'm making it sound. The fact that the rate is low for longer tells you that there is something wrong. So it's not a case of just buying anything, which is what people seem to be doing. You have to be a bit more discerning. I can understand why people will take baskets of investment grade credit. That makes a lot of sense. I can see that. But high yield may have moved too much. And if you look what happened in Japan over the last few decades, we didn't need a recession for the credit spreads to widen out. Stuff happens. Periodically, things are going to happen. We're going to have accidents. There is so much leverage in the system. So we have to be discerning.
Well, let's do this. Let's come back with Stephen Major right now. These are really important comments. I just put out on Twitter this thought on the real yield as residual. It's a little bit tough thinking on a Friday, but a very important concept by Mr. Major, as we heard from John at Writing. We're going to come back right now. Turkish lira out 3 standard deviations. It just weakened out to a new level as well. I don't think Lawrence Kudlow will speak on Turkish lira today with John Farrow. He will be at the White House, the National Economic Council director, on what the president calls that big Friday report. This is Bloomberg. It's Jobs Day. Stay with us.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
You see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Surveillance. Good morning, everyone. An exceptional week, really exceptional 2 weeks of news flow. Jobs Day today in America. Francine Lacroix in London. I'm Tom Keene in New York with us, Stephen Major, and we're looking at really the yields where he suggested they would go. You never know why they go there, but they get there. Stephen Major, an open question to get out front of your next essay for HSBC. What's the unexpected out there that has your attention? Expect the unexpected. Let's go all Margaret Thatcher right now. What's the unexpected in full faith and credit that you're worried about?
Well, I'm worried about things getting worse than they already are. I know that most people might come on the show and talk about inflation and inflation surprises. A lot of that is loosely based on what's going on with the money supply, but I don't agree with any of that. The money supply is mainly explained by increased savings, and savings have gone up for a very good reason. It's risk aversion. So I would be worried that policymakers are starting to be scraping the bottom of the toolbox looking for new tools. I heard the Bank of England talk about the various tools that are in the box, which is all very well because it's saying that they've got the ability to do more. But really, I guess we're going to find out. I mean, I've written a lot in the past about some of the constraints on these policies. It worries me that the emperor has no clothes, and at some point that gets found out.
You know, Steve Major, Vincent Reinhart and Carmen Reinhart, both just phenomenal economists, have just co-written a wonderful piece for Foreign Affairs calling it the pandemic depression. What is the best full faith and credit policy if we get a Reinhart pandemic depression?
Well, at the moment, they're doing everything they can on the fiscal and monetary side. I mean, people will argue that more could be done, but it strikes me that at some stage we're going to have to bite the bullet. And this is the debate that's going on in the US and UK. How long do you keep the furlough schemes going? I mean, I can see both arguments here. People need the money. The economy needs to keep going. I see that. But of course, there's another argument, isn't there? Is that if you do it for too long, you start to create a kind of ossification. You start to pacify people. You zombify companies, and it's very, very difficult. And I think we do have to start accepting that we're in for the long haul. So perhaps the best thing that could happen is that people would be a bit more realistic and honest and stop promising themselves V-shaped recoveries.
Stephen, what do you do with what the Bank of England said yesterday? I don't know if you have concerns about maybe forecasts that were too optimistic, or actually, the timing of possible negative rates.
Well, we're forecasting zero gilt yields for the 10-year, and we've been forecasting low gilt yields for a while on the basis that rates aren't going up. There's still the possibility they go down. The way I look at the various policies, it's about scenarios and probabilities. Not saying that the rates are going to go negative. That's not our forecast. But I'm saying it's a non-zero probability. Now, that kind of matters. If it's possible that they go negative, the whole term structure is going to go lower. And this is a story maybe for next year, but probably not for now. But look at the gilt yields out to the 7 and 8 year. They're already there. They're already going to negative territory. So, the market is starting to sense that more will be done in time. At the moment, the preferred tools are the guidance and the QE. They've done their analysis. I think the problem with QE is it can only go so far, and it is constrained. There's only a certain amount you can buy. There's only a certain amount of reserves you can pump into the system, and the Bank of England knows that, which is what informs the next steps.
If you look at central banks around the world, I mean, who has it toughest, Stephen? I guess the UK is also potentially dealing with a no-deal Brexit at the end of the year.
Yeah, well, let's start with the one that has it the easiest. And you might be surprised to hear this, but I think the ECB can now start to feel a bit more comfortable because they've got governments pulling in the same direction. Who would have thought at the start of this year that Germany would be loosening fiscal policy like it is? Who would have thought that we'd have a next generation recovery fund? Who would have thought that we're moving towards common issuance in 2021? These are all wonderful steps. And for the ECB, it was a game changer. Everyone said it already. So they have things a bit easier because they were doing everything on their own before. So that's something positive, Francine. Who's got the toughest job? Well, it might well be the Fed. And in a way, the US market is lagging all of the others. And I think this is often missed. The ECB and the BOJ were already in negative territory. We've seen the same thing in Switzerland. And the US has come relatively late to the party in this low yield environment. So I think the constraints on US QE might not be that far away as well. So if I had to rank them, I'd probably say that the ECB is in a better position in general, and it's probably going to be tougher for the Fed. A difficult question, but you knew that anyway, Francine.
I did, Stephen. Brilliant as always. Stephen Major, their HSBC Global Head of Fixed Income Research. Now, coming up on the Open, Mohamed El-Erian, Allianz Chief Economic Advisor. That's coming up at 9 a.m. in New York. That's 2 p.m. in London. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg surveying us from London, from New York. This Jobs Day, an extraordinary set of hours of conversation ahead for us. Please stay with us. A lot of good guests. Ellen Zentner and Jim Glassman joining us near that 8:30 report. Right now on Turkey, and this is a really interesting economic issue that involves the domestic and the international future for Mr. Erdogan. And what it comes down to is there's an experiment that has happened, and that is we're going to goose the economy. We're going to keep interest rates low, and to hell with the currency. Oner Ott joins right now, Bloomberg's Turkey bureau chief. Is the experiment over, Oner? Are we done with the idea of boosting the economy and to hell with interest rates in the lira?
Yeah, I wish I could say I knew the answer. It may be over, it may be, or they may have just come to a pause, Tom, because it looks like it's getting increasingly difficult for policymakers to do all that three at the same time. As you said, with a limited amount of foreign reserves, and inflation that seems to be on the rise as compared to official projections, and the fact that there's a credit boom fueling a widening current account deficit just makes it impossible to keep the economy going at this pace and keep the lira in check.
So, Oner, what more can authorities do to try and stem the slide?
They've done a variety of things since yesterday, and they're quite interesting when you look at the sort of elements of the policy U-turn, I would call it, that's been on display since yesterday. They stopped defending the lira. State lenders stopped defending the lira, while the banking regulator has eased restrictions on lira offshore markets. That's quite a change given what Turkey has been trying to do over the last 18 months or so. And now they're talking about they're planning to roll back regulations that force commercial lenders to boost credit through the economy. So overall, regulators and policymakers seem to be leaving behind the policy mix that they had for the last 2 years or so, and they seem to be trying to portray this as part of a normalization process in the economy as the pandemic dissipates, if there's such a thing, of course.
Oner, I'm looking at dollar Turkey. Sometimes I look at euro Turkey on this, folks, and this is dollar Turkey, dollar lira. And 4 standard deviation move with the spike up there, that's a weaker lira, is a 7.48. Is a rule of thumb, Oner, that you get to a 4 standard deviation move in bonds or FX and bad things happen? What are the bad things that are going to happen?
I don't know what are the bad things that are going to happen, but surely the move in the lira against the dollar and the euro has been quite sharp in recent days. And what the central bank and banking regulators did to stem that seem to have maybe slowed the decline, but not put an end to it. And I think when judging by the commentary out there by people who are watching Turkey's economy, it looks like Turkey watchers are expecting more than just liquidity-related measures to put an end to the lira's plight.
Got to leave it there, Oner. Thank you so much. Our Turkey bureau chief in Istanbul and Ankara today. I mean, just really extraordinary, the movement. We'll have much more on this through a busy day in America. Coming up later, Bloomberg Markets Secretary of Labor, he will report on the American labor economy. Stay with us. This is Bloomberg.
Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Tom, President Trump signing this executive order banning U.S. residents from doing business with TikTok or its Chinese owner ByteDance, beginning in 45 days. Meanwhile, Microsoft co-founder Bill Gates said the software giant, which is in talks to acquire the U.S. business of Chinese-owned video app TikTok, is also careful about promises to keep data safe and wouldn't do anything viewed as hostile as it navigates U.S.-China concerns. Well, we spoke to him earlier this week.
Well, the whole situation is quite novel in terms of, what are the principles involved here? What principles should China apply to companies in China or the U.S.? Are those reciprocal and thought through and predictable? I'm not, at the company now. We've made investments in China. We have, engineers from all over the world, including in China. So Microsoft is very careful about its data promises, and we'll try to have strong relationships globally. We won't do things that are hostile, are viewed as hostile.
What about the app in general? Obviously, it's a very popular app. I mean, is this something that you would like to see in the Microsoft family?
Well, it's nice that TikTok's created some competition through innovation, and it doesn't seem like preventing that innovation from being available, that makes much sense when you want new things out there. I am not in the target audience, so I'm certainly not expert. I've gotten a lot of education from my youngest daughter about this and why she spends time on it. So, they did a great job on it, and there's a lot of ways to take it, and hopefully, that's allowed to happen in some form.
Let's talk about what's allowed. Is the Trump administration correct in trying to force this Chinese company, ByteDance, to sell TikTok's U.S. operations or even shut it down in the United States because it's Chinese? Should the company be subjected to that? I mean, 100 million Americans are using it.
What law? I mean, if this is such a clear thing, why wasn't it clear 3 months ago, 6 months ago? When people make investments, they should understand what's allowed, what's not allowed, and therefore what's the reciprocal principle involved in this thing. So, maybe I haven't read the right article. I don't understand what happened on Saturday, but anyway, I'm focused on the foundation and the pandemic, and I'll probably provide advice at some point, but I'm not at the center of this, the decision being made here.
I do want to quickly get your thoughts on the antitrust situation. Obviously, I'm sure that the hearings have been a bit of deja vu for you. Having gone through a lengthy review process yourself, do you look at companies like Apple and Amazon and Google and Facebook and think they've become too powerful? Is this an effective way to preserve competition?
Well, these companies are shaping the economy. So the idea that congressmen get a chance to talk to their leaders and try and understand how, what they're doing in terms of media and competition, that all makes sense. They were lucky there were 4 of them on the hot seat. I was all by myself with critics sitting next to me. So, hey, I guess we're getting nicer to CEOs than in the old days. I always felt going to Washington and talking about our values and what we did, was helpful, particularly, through this pandemic where these companies have done so well. Now understanding, what's it like to be an entrant into these markets. There's legitimate issues there that in a kind of a scattershot way did get raised.
Well, that was the Microsoft co-founder, Bill Gates. Now, joining us to talk about all of this is Derek Wallbank. He's Bloomberg's senior editor in Singapore. It's very clear, Derek, that actually, the Trump administration definitely widened the China tech attack, also banning Tencent's WeChat on top of TikTok. Do we know where this ends? Are we going to see more, attacks similar to this or more bans similar to this?
Well, yeah, Francine, and the WeChat notice that came out from the White House was a bit of a surprise. I think we had all expected, because President Trump had said that TikTok was going to have to be divested from ByteDance within by September 15. We had all sort of expected something like that would happen. So when the White House executive order on that one came out, it was like, oh, okay, this is a big deal, but this is sort of in the same frame that we were thinking here. When the one that came out on Tencent's WeChat came out, it was a complete thunderbolt from the blue clear sky. I don't think a lot of people were expecting it, and Tencent fell by as much as 10% in Asian day trading as a result of that. I mean, nothing like that was priced in at all. So what we're looking for now is the executive order said that over the next 45 days, there would be some form of guidance on exactly how this is going to work, what sort of transactions are going to be blocked, how the order was saying specific to WeChat. Well, what does that mean? Does that mean everything to do with WeChat? Does that extend to other parts of Tencent's universe? We're told by a senior administration official, told our Justin Sink, that this is aimed at WeChat, but this is going to be one of those things, where the devil's in the details, and the details haven't been released yet.
Derek, the details haven't been released. Is there any evidence of any wrongdoing here by the Communist Party?
Well, I think that there has been, some clear reporting that WeChat has had, some ties to China's state system, and that's certainly something that the Trump administration was trying to outline as being problematic. They put out a fairly good-sized list of reports that they think are problematic, and the Trump administration cited national security in both the TikTok and the WeChat orders.
How does China retaliate from this, Derek? Do we have any insight of how they're viewing this and what they're waiting for?
Well, the first thing that's going to happen is that TikTok has said that it's going to challenge this somehow. I think that was somewhat anticipated, even as it's going on through the talks with Microsoft. Now, China's state media has come out and said that the entire U.S. action towards TikTok and ByteDance is a smash and grab, so that hasn't been received very well there. On the WeChat side, I think it's very, very much early days. We got some response from China's Foreign Affairs Ministry. They were obviously not very happy about this. Use some strong words, but in terms of what action is taken, it's going to be tough to say here. The other thing that's difficult about this, Francine and Tom, is that going after WeChat actually might hurt some American companies who are operating in China. If you're Starbucks and you're looking to do a promotion on WeChat, or you're looking to accept WeChat payments for a purchase of a new Apple iPhone, how does this affect you? So I think there's a lot of things here in terms of those details that have yet to be fully understood.
Very good. Derek Wallbank, thanks for the brief. Greatly, greatly appreciate that. Now to the news here, a busy news day with our first word news in New York. Here's Ritika Gupta.
Thanks, Tom. President Donald Trump is moving to ban TikTok and WeChat in the U.S. He signed executive orders barring U.S. residents from doing business with the companies. It also applies to TikTok's owner ByteDance, but not to broader business of WeChat owner Tencent. Now, TikTok says it's shocked by the move and will challenge it. Another round of monetary stimulus is expected from the Bank of England. Policymakers yesterday said the hit from the coronavirus was shallower than initially thought, but that upbeat assessment was lost on the markets, driving the doubts and expectation for more flare-ups of the virus and a messy Brexit. Governor Andrew Bailey says he's ready to support the economy as necessary. There are still hopes for a speedy economic recovery in Germany. A rebound in manufacturing is starting to catch up with services sector. Industrial output gained nearly 9% in June. That follows on from figures yesterday that showed factory demand is rising. It suggests Europe's largest economy may bounce back more quickly than its neighbours. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thank you so much. A big storm a few days ago, huge power outages around the tri-state area, and now Manhattan. There is a substantial power outage beginning about 25-30 minutes ago. It is certainly on the upper west side and some of the upper east side, and then up to the upper parts of the island. There is power on parts of Manhattan, it appears, but a very, very large of Manhattan without power. We'll continue with powerful conversations through the morning here on this Jobs Day. So much going on. Futures, -18. Stay with us as well on a very dark New York City. This is Bloomberg.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
As the nation prepares to vote during a pandemic, how will mail-in voting shape the 2020 election? I'm Kevin Cirilli. Join us on the Bloomberg Special Report. Vote from home this weekend on Bloomberg Television.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London with power. We are in New York on generators, I believe, here at Lexington Avenue. There is some power in Manhattan, but a huge blackout across Manhattan right now. We'll keep up to date on that for our global audience and for New York Wall Street as well. It is sport, to say the least. On this Jobs Day, we will speak to a lot of economists. Stephen Blitz is well known for very acute essays on not the granularity of the data, but what the granularity means. He joins us now with T.S. Lombard. Stephen, we're going to talk to a lot of fancy people today, including you. You have a gift for saying, okay, we don't know what's going on, but here's the choice set or set of outcomes. What are the set of outcomes at 8:31?
Well, I think the main outcome that we have to watch is the number of jobs, people unemployed where the jobs have been lost permanently. It's up to around 3.7 million last month, June. And that puts us just at the beginning of a real recession. Normally it gets to around 4 to 5. In the 07, 08, it got to 8 million. And recessions peak in unemployment at the end of the recession, it's not at the beginning. And so what you have here is you have this COVID-created contraction, government-created contraction and reopening. And so a lot of these temporary jobs are coming back. They are not all going to come back. And by the end of the year, we're going to see 8 to 10% unemployment. And that's why you got negative yields.
Do you suggest
negative real yields?
Well, the stimulus is urgent. I think we all agree on that. But do you suggest that there will be further stimulus as we move towards 2021 with your 8% unemployment rate?
No, this is it. This is the last fiscal dance. And most of what's going to be in there, like the extension of the unemployment insurance benefits, will expire probably Jan 31 next year. So the next round of stimulus, and we're still, I don't even think of this as stimulus. This is still a financial bridge to hold things together until the economy really finds its footing and begins to expand again as the pandemic ebbs. So the next round will be left to either Trump or Biden and whatever the Congress looks like come January next year.
But Stephen, how many jobs will actually go forever? How many of those job losses that, some of them will come back, but how many will be permanent?
Well, I think permanent means not no jobs will ever come back, obviously. It just means that they're permanently lost now as opposed to temporary furlough, and probably gets to around probably up to about 8 to 10 million, which gets you to that 8 to 10% unemployment rate, which is a severe recession in the United States. And, just to keep with the current news flow, it wouldn't shock me that this is a very bad number today, because obviously Trump's executive order shifts the focus of the markets and shifts the focus of attention away from the data towards his relationships with China.
Okay, if the situation with China gets worse, what does that do to the U.S. economy?
Well, it certainly doesn't help. And this is certainly a time when you want the Chinese to continue to buy what we have to sell, and you want to sustain a commercial relationship, which is why these things are 45-day executive orders. Look, I think a lot of this is a lot more noise than fact. And Trump's not going to throw out the phase one agreement. He needs it, and that's a line he won't cross. And I think the Chinese understand that there's a certain amount of bluster that goes on here and noise, and then they get into a transactional relationship and things go on. Maybe not exactly the way they were, but things have a way of settling down.
Stephen Blitz, thank you so much. Greatly appreciate it with T.S. Lombard this morning. On the blackout, and a lot of this is speculation and the Twitter stream and all that. Some of it is news organizations as well. There is a blackout in Manhattan. I'm beginning to see some reports of lights coming back on selectively in the Upper West Side, maybe a few other geographies, but I want to be very careful there. There is a blackout in Manhattan. And it seems to be they're working on it as they move through the sunrise of New York City. On the open on this Jobs Day, Anastasia Amoroso will join. Also, Dr. El Arian and Mr. Prince of Bridgewater. Rick Reeder as well. This is Bloomberg. Good morning.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. For the first time, Uber made more money delivering food than it did from transporting people, but that failed to offset a steep decline in ridership. Quarterly sales fell 29%, ending a decade of growth for the ride-hailing giant. But the company is maintaining its goal of turning an adjusted quarterly profit by the end of next year. Long the number 4 in the US wireless market, T-Mobile is now officially number 2. Its merger with Sprint has helped the company overtake AT&T to reach over 98 million subscribers. It expects to add up to 1.9 million new monthly customers this year. First-placed Verizon has about 119 million customers. And that's your Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. Now, the Bank of England is trying to reassure investors that they won't tighten monetary policy anytime soon, even with better than expected forecasts, as they try and support the economy through the long road to recovery. Well, I spoke with the governor, Andrew Bailey.
The things we've looked at are broadly further QE, further quantitative easing, potential use of negative rates, and forward guidance. Those are the things that we've looked at.
So yield curve control has not been discussed, or is it something
I mean, obviously yield curve control is quite interestingly discussed in central banks, and we do discuss it. It's something that, I mean, we've preferred to look at quantitative easing and forward guidance as tools in that respect. But I would make the point that we will go on looking at the toolbox. You know, nothing is fixed down forever, but it's not in our planning at the moment.
What would it actually take for you to go into negative rates?
The issues that we most focused on, and we've talked a lot to the central banks that have done them. Those have gone in, come out, gone in, not yet come out. Really very, very helpful and fascinating conversations, lots of the work they've done. And I'll draw 2 points out of it. One, as you get into this territory, there is, I think, a much bigger interaction with the structure of your financial system, and particularly the structure of your banking system. You know, nobody has really sent retail deposit rates negative, and I can understand why. Obviously, it means that the bigger the share of retail deposits in your banking system funding, you know, the more attenuated the effect of negative rates will be. We've actually got quite a high share of retail funding in the banking system, so that's one thing. The second thing that I would conclude, looking at the experience of some of the other central banks, is that the effectiveness of negative rates does depend upon what point in the cycle you're using them at as well. And again, that's an interaction with the financial system as well.
But so would you see yourself using negative rates, you know, post-COVID, so in a recovery phase, to actually help the economy then?
Well, I don't know is the answer, because we're not facing that situation today. I think it is true that I think when you look at the experience of other countries, they appear to have worked more effectively in the recovery phase. Now, I would, however, qualify that a bit by saying I think there's a tricky identification issue at that point as to what extent it's negative rates that are driving, for instance, the recovery of the banking system, the lifting of the release of provisions, and therefore the ability to lend, and to what extent that would have happened anyway, because it's a cyclical point. It's a rather tricky issue in that respect. So the evidence is there, but it's a little bit hard to identify the causes.
But then again, in terms of sequence, it's not something that you would rule out, right? It could happen at that phase.
Oh, definite message we're giving today is, look, they're in the box. I mean, there are other central banks that have said they're not in the box because, again, their financial systems have got different properties and they draw different conclusions, so I can understand that. They're in the box. We're not considering using them at the moment.
That was an interesting conversation, Tom, that we had with Governor Bailey. And, you know, I guess it's quite difficult to try and explain to the markets why their forecasts were so high. But it was very clear in speaking to him that actually they hadn't really accounted for a possible second wave or a lockdown. So it's a different way of doing forecasts than some of the other institutions.
Well, it's been different. They had a V-shaped recovery starting out months ago, his first days in the Bank of England, and that has changed radically as we've seen the pandemic change as well. Let me look at the data right now. Futures negative 16 have deteriorated a little bit. Dow futures negative 135. We're up a stick on the VIX, 23.89. That's off that very good close that we saw yesterday as well. We're watching the yield market. Yields come in further, including that real yield negative 1.10. A distraction to all this is a power outage. No, not in the tri-state area, but a power outage across New York. The good news is there's reports of power coming back on. I just heard from the Harlem area, the 114 area with power back on. Power on the Upper East Side. Charles tweets in, thank you, Charles, for that update on the Upper West Side. That was very good to see there. All of our viewers and listeners coming in here. But seriously, there is still a power outage to greet the sunrise in Manhattan. Stay with us through the day. It is Jobs Day across America.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This morning is never before the American Jobs Report. It is a complete mystery, from a halted recovery to the optimism of, quote, a lot of momentum. What will the 8:30 report do to our belief in a pandemic recovery? None other than Reinhardt and Reinhardt. They say we are living a pandemic depression on this August 7th. Stimulus and income replacement, it is needed. Congress dithers. And the presidential goal, well, it's quote to protect our nation, TikTok, and now WeChat are a national security risk. How will China, for that matter, how will Apple respond? Good morning, everyone. This is Bloomberg Surveillance Live from our well-lit world headquarters in New York. I'm Tom Keene with Francine Lacroix. I don't think it has anything to do, Francine, that Mr. Bloomberg was the 108th mayor of New York, that the lights are on here. I mean, I don't want to go there, but we are well lit on Lexington Avenue on the Lower East Side. And Francine, too much of Manhattan seriously in the dark. Some lights coming back on. Con Edison is working on it.
Yeah, I mean, I think a lot of the companies probably just have contingency plans with generators, Tom. That's something that we need to, you know, keep an eye on, because of course, if you're going to work and don't have power and you're working from home, then it's something that will affect you. What else will affect you is, of course, the stimulus. If there's no deal today, and that I don't know, Tom, what you're hearing, but feels like it's very 11th hour. So I'm looking forward to speaking to Jack Fitzpatrick on that. And then you have these rising tensions between the U.S. and China on technology.
Yeah, there's no question the technology has heated up overnight, folks. We'll do a little bit on that here within this huge economic news flow. I'd also point out Turkish lira continues to deteriorate. We spoke with our owner aunt in Istanbul and Ankara, and it is not good in Turkey as well. So much news flow. Let's get a morning briefing. Our first word news, here's Ritika Gupta.
Morning, Tom, Francine. All eyes are on this morning's upcoming jobs report after a surge in coronavirus cases across the U.S. All signs point to a slowdown in job gains last month, or worse. Today's employment report is forecast to show a 1.48 million increase in non-farm payrolls in July. That's following a combined rise of 7.5 million in May and June. The unemployment rate is projected to fall 10.5%, still triple the pre-crisis level from 11.1%. There's been no headway in talks between the White House and Democrats over a new virus relief package. There are still major sticking points, and both sides are accusing the other of refusing to compromise. One key difference is still the top-line number. The Democrats want $3.5 trillion of aid, and the Republicans want $1 trillion. President Trump is moving to ban TikTok and WeChat in the U.S. He's signed executive orders barring U.S. residents from doing business with the